evening, everyone. So thank you once again for joining us today. And as you probably already know from our webinar title, today we'll be talking about Treasury bills, in short T-bills. And I'm Feng from Bond Supermart. I'll be doing a brief introduction on what our website has to offer. And along the way, I will also touch on some of the things that our other speakers will be going through so that you guys can have a sense of what will be in store for all of you. Yeah, so without further ado, let's begin. And I trust that some of you might have noticed that I mentioned that I'm from Bond Supermart. So if the question pops into your head, you might also wonder, like, what's the difference between Bond Supermart and Fund Supermart, right? Okay, so actually we are both under the IFAS group, but FSM, it's an online investment product distribution platform for investors. So they actually carry a wide range of products and services like funds, bonds, ETFs, and more. On the other hand, Bond Supermart, as the name suggests, focuses on bonds. So we are actually a bond information portal and we support bond information that is shown on FSM. So that's it. That is how we come together to serve investors. So because Bond Supermart is an information portal, it has no transaction capabilities. So investors can buy bonds through FSM1. Now, for those of you who may not know, let me share with you guys how you can see where you can buy bonds. So over at Bond Supermart on our bond fact sheet, you can actually hover over the transact button. Okay, as you can see on screen. All right, you can actually hover over it to see what platform the bond is actually distributed at. So there are hyperlinks to make it easier for you, and they will redirect you to, for example, FSM platform, as you see on screen. Yeah. So over at FSM platform, if you're a user, you probably know that there are also bond fact sheet available on the website as well. And it shows you indicative prices, performance charts, so on and so forth. So I'll not go into the details here because later Timing will be explaining further and also sharing with you guys how you can use this to evaluate a bond. Yeah. So then you might have the question on, since fact sheets can be found on Bond Supermart and also FSM Fund Supermart, then why the need for Bond Supermart? So basically because Bond Supermart is a bond information portal, right? So as mentioned, with this focus on bonds, coverage will be wider. So we also have regional analysts sharing insights with us. For example, we have analysts from Hong Kong providing updates on the Chinese real estate development. There are also some bonds that information can be found only on Bond Supermart. Yeah. So not only that, we also have our very own podcast series. It's called You Hunters. It's actually available on Spotify, Apple Podcasts, as well as Google Podcasts. So if you guys are free, you can go over to the website and check it out. It's also listed on Bond Supermart as well. Yeah. If you're interested, you can also join our little Telegram bond community so you can get updates on the go. Okay, since everybody is very busy, it will be good to be prompted with the latest news, right? So on our Bond Supermart Telegram, we actually share about new bond issues. We also share about the podcast that we have mentioned. When there are new episodes, we will ping you so you get notified. We also occasionally do polls to engage our audience. So for example, sometimes we ask about rate hikes or we ask our audience what they think the upcoming T-bill rates will be. So you can join us and interact with us through these polls. Yep. And we also have various infographics to break down information in a more digestible manner for our audience. So one example is the T-bill auction results. Okay, this is perhaps something you can refer to since, today our webinar is surrounding about government securities, right? Yeah, so we have the QR code there. So feel free to scan it or you can just search for Bond Supermart on Telegram. You should be able to locate our channel. Yep. We also have several articles on the government securities on our website. So you can join our group chat and then you will be able to receive updates on the go because we will post about them whenever there are new articles. Okay? Yep. So speaking of T-bills, the recent one has a cutoff yield of about 4%. And since our webinar title is predicting where they are headed next, right? So let me share with you a couple of useful pages on FSM Fund Supermart website as well. All right, so on Fundsupermart's homepage, the bonds homepage, you will actually see that we do announce new bond issues, as I have indicated on the slide at the bottom. Yeah, so new bond issues will be announced, including Singapore Treasury bills, the T-bills, which you can actually subscribe to it. Yeah, so Marcus later, he will elaborate more on the mechanics and how it works when you subscribe to T-bills through us. So I will leave that for Marcus later on. Yeah. And I also wanted to share that FSM actually has a very, very useful page, which is one that is dedicated for SGS bonds as well as T-bills. So it's under the bonds tab. If you hover bonds, and then after that you see under bond info, you should be able to see what I have highlighted on screen on SGS bonds and the T-bills. So we do have all the bonds listed over here, so you can actually sieve through the SGS and the T-bills to find your preferred bond. So hopefully this will be helpful, and it's something that you all can explore later. You can have a look at both Bond Supermart's website and also Fundsupermart website. Okay, so that's a brief introduction for you guys. And with that, I will end my presentation. Back to you, Ikai.
Thank you, Fong Yi, for the sharing. Sorry for that. Give me a moment to adjust some settings. All right, I will now pass over to Timing, who will carry on, and then he will share with us sovereign bonds. Yeah, Timing, please.
Hello. Right. I'm Timing from the bonds research team doing research for IFAS. So for myself, thank you all so much for joining us on a Wednesday evening to hear us out. For my part, I'll be introducing on going through a little bit basic understanding on bonds itself, and also running through a couple of recommendations, a few on the sovereign bonds, and also one on the corporate and retail bond. So coming to my first slide. So let me do a quick recap on how a bond works. So imagine yourself as when you're buying a bond, you're actually lending money to an entity. When you're lending a money entity, for example, you're lending a $1,000, you're able to earn interest on that lending that you give to the on the borrowing that you give to the entity itself. So for example, you are earning 5% of interest on an annual basis. Earning 5% of this 1,000, you can expect to get about $50 on an annual basis. At the end of the lending period, beyond just the interest that you've been getting back on an annual basis, the entity will also return you the capital after the entire lending period is over. So for bonds itself, there is a contractual agreement between you and the entity that the entity will pay interest and capital. But of course, the entity ultimately depends on whether they have the cash and liquidity for them to pay back, which ultimately for you, if the entity does go into default, you can actually go after them in the sense that you can get them to liquidate and to take on their assets in the event that they really do go into default. So running through a little couple different types of bonds. So for bonds itself, it is a little bit more complicated than stocks itself, which stocks pretty straightforward. You have ordinary shares and also the preference shares. But for bonds itself, that comes in different type and come in different forms. So firstly, we have different entities which bonds can be issued by the government or by corporates. So for example, we do know that Singapore government, they do issue bonds like your T-bills. Even PUB, Public Utilities Board, and also Housing Development Board, they also do issue some of the bonds also for different purposes, such as for the development. On the other hand, we do have a couple of different options on the bonds itself, put options, call options, and even convertible options on the bonds itself that can be exercised either by you as the buyer or by the issuer itself. Of course, something more important to understand is also the seniority. So in the event of a default, how much you can claim or how much a bondholder can claim will undergo this seniority ranking before they can determine who will actually be able to claim first. The secured will take first, then is senior, then followed by subordinated. And also lastly, not forgetting the structure. So for those, for you guys who might be a little bit more familiar with T-bills, T-bills is an example of zero coupon bonds. So zero coupon meaning to say it doesn't give interest, however, it provides you the yield by the capital appreciation. And of course, there are other different types. We have floating coupons, we have bullet, that means fixed rate coupons. We also have contingent convertibles, your COCOs, also asset backs. So this is just to provide you exposure of the different type of bonds that are on the market itself. So giving a little bit better idea on how you can actually earn from bonds, if you think about stocks itself, it is quite similar in some sense. So for stocks and shares itself, they do give out dividends, And in this case, right, the coupons are similar to the idea of dividends on shares itself. So through bonds, you earn the interest, which is also known as coupon, on a regular basis. So this coupon is expected to come in on a semi-annual, annual basis, or even on a quarterly basis. On the other hand, for shares itself, you do expect for a certain form of capital appreciation. It is the same thing for bonds itself. You could be buying at a cheaper price, which ultimately, upon mature, you can actually go back to the price of 100 or the par price, which allows you to get this capital appreciation and the yield from bonds itself. So these two aspects of dividends and capital appreciation is very similar in terms of what you get from shares itself. Coming to how you can actually read a bond fact sheet. So I'm going into a little bit more details. So in the red color box itself, you're able to see the name and also the issuer and what type of bond it is. So in this case, we can see that, oh, it's a Singapore Treasury bill. This is issued by the government. And ultimately for this itself, the most important thing is the maturity date. As you can see, the maturity date of 20th February 2024. This will ultimately let you know what is the investment time horizon and how long the maturity you are expecting when you're looking at the bonds itself. This will allow you to quickly gun through the different types of bonds, the availability of bonds, and how the maturity will be. Of course, on the orange color box, this will probably be another important information, which is showing you the price of the bond itself. On the left-hand side, there's bid price. On the right-hand side, in the orange color box, there's ask price, which, if you're familiar with funds, this is similar to the bid offer spread on funds itself. For ask price, typically, we recommend clients or investors to look at ask price because that ask price typically ask price on a more conservative basis, given that ask price is based on what sellers are willing to sell the bonds at on the secondary market. Lastly, for the green color box, it is mainly referring to the general information you can get, can understand itself. So with regards to the bond, as you can see for Singapore T-bills, it's of a low complexity. So it's quite straightforward to understand. And of course, on the other hand, for investor profile, which profile of investors is this type of bond suitable for? In this case, Singapore T-bills is also an alternative to fixed deposits. So for investors who are looking at alternatives, not just fixed deposits, they can examine these Singapore T-bills. Coming to the next slide. So this one is a little bit more straightforward, which I believe most of you have seen if you're looking at references to stocks and shares. Ultimately, we do show a historical performance and movements of, like, let's say, the price and use itself, which during period, you can see over the time, how has it changed, what has changed. This can draw in contrast upon maybe certain events, certain news that allows you to have determine some useful information to see, hey, because of this certain information or because of this news, has the price on these T-bills has changed. This will work for all the bonds that we have on the platform as well. Lastly, coming to a little bit more details, the last piece of important information. So in the red color box, it will tell you the period left to maturity. This will be important. Ultimately, the investment is based on your time horizon, and this will allow you to understand what's the commitment period required to have in the event you are holding the bond to maturity. In the orange color part, it tells you the minimum amount you have to invest in, and for every lot that additionally you want to buy, how much of an increment there is a need to. For the green color box, this is the most straightforward part in terms of understanding the credibility of the issuer. By looking at the credit rating, you don't have to read too much into the company itself, understanding the balance sheet. Having the credit rating will quickly allow you to understand, is this company safe? Is this company certain things that I have to take note of? This will be indicated here. Lastly, the seniority itself, as I mentioned just now, the seniority will ultimately determine, in the event of a liquidation, the hierarchy or the ranking of the claims that bondholders will be on. So ultimately, secured bonds will take priority first, followed by senior unsecured, as you can see here, and lastly by subordinated. Right, so coming to the highlight of today's sharing, the Singapore government securities, which also includes the Singapore T-bills, the Treasury bills. So of course, I believe most of you are coming after we see the very attractive 4.07% on the 6 months T-bills, which was the cut-off view on the previous option. This was a relatively large jump from the previously it was at 3.73%. Of course, giving you some color and some clarification. So what happened on the day itself, right? Even though we do see the cut-off view at 4.07%, the daily average yield actually immediately fell back to 3.94%. This is the average yield on the T-bills that is traded on the secondary market. And and currently now is trading on 3.91% accurate as of yesterday. Providing additional color again. So for this 4.07% on the last option, right, we do see a bid to cover ratio. This bid to cover ratio simply means the amount that was bidded or demand as compared to the amount that MES allowed for issuance. So it was at 1.76 times. This is a lot lower than the average 2.1 to about 2.2 times in the previous few options that we see in the recent period. So as you can see from this graph also, since January, we have been seeing a divergence from the US interest rates, which is the US federal funds rate, and versus the 6-month T-bills and 1-year T-bills. So even though the US continued on their rate hikes, across 2023, they have hiked another 4 or 5 times. And even now we are looking at potentially another hike. Yields on the T-bills, both 6 months and 1 year, have been relatively stagnant. So this 4.0% likely is going to be an exception case whereby because we have lower demand on the previous auction, it allowed for a lower price and therefore a higher yield on the thing itself. But in general, what we feel as a house view is that it is quite difficult for yields on the T-bills, both 6 months and 1 year, to continue rising, especially based on this trend whereby it is diverging from what we see from the US market. So we believe that the T-bills yield is slightly range bound between 3.7 to about 3.9%, which ultimately this divergence, or rather it's stagnant and falling off, might be more in 2024. This depending on how the interest rate might develop in 2024. So our current stance on T-bill is that it is highly attractive, given that current yields are really hard to find across history itself. So first attractive point is definitely the fact that we are looking at the AAA ratings across all the major rating agencies on the Singapore government, and the fact that having T-bills allows you to, it makes it easier for you to pivot into equities should there be opportunities, because ultimately holding T-bills allows you to sell on the secondary market as compared to, let's say, you are parking your money in the deposit. You are required to hold on to them until maturity before you can actually utilize them. Lastly, we do not feel that the rates are likely to see any more increase, even definitely not above the 4.4% that we see at the end of last year, at the start of this year, even with another round of potential rate hike. So ultimately, we do feel that these are the specific or the very good reasons that why investors should be looking at T-bills in the current moment. However, on our platform, T-bills are not the only option in case you are looking for somewhere safer to invest or to park your monies. So our platform itself, right, we do have a large variety of Singapore government bonds. I'm just showing a couple of on this slide itself. We do have bonds of various different tenors, and looking at the yield curve itself, right, on the chart below, this is the reason why we prefer the short duration bonds at this point of time, because by taking on a position in the longer duration, looking at 10, 15 or 20 years, right, you're not compensated for the risk that you have to undertake for long duration. And at the same time, we are looking at highly attractive yields in a short duration. And therefore, that is also one of the very big supporting reasons why we like the T-bills so much currently at this point of time. So something else to also kind of look at is the US Treasury. And this is another sovereign bonds that's currently in the spotlight that is also available on our platform. So looking at the trend since the start of 2022, we have been seeing the US interest rates hiking aggressively across 2022 itself, and even in 2023 we are still looking at some increments since the start of this year. For 6 months, 1 year and 2-year US Treasury, it has been increasing alongside the US federal funds rate, which currently they are all yielding at around more than 5%. So something important to consider is what is the market expectations of the federal funds rate in the upcoming meetings. So looking at the market expectations upcoming into early 2025, the market expects for rate cuts as early as middle of 2024. Our house view, the iPass house view, our view is that it is likely for Federal Reserve to continue holding rates higher for longer, and we are not expecting the Federal Reserve to really cut rates until the end of 2024. Why? This is ultimately because we are still seeing very persistent, sticky inflation in the US market. Even though we do see inflation coming down recently, headline inflation particularly has spiked up again in the US. It has reversed its downward trend in August, since July itself, mostly because of spikes in the energy costs, whereby oil prices has resulted in higher inflation in the recent period. So similarly, showing you a couple of the offerings that we have, but we have a lot more on our platform. So these are the few T-bills, the US Treasury that we have on the website, each of it offering more than 5% yield. These are good for investors who has excess USD holdings. Why recommended for clients with excess USD holdings? Generally, we are not recommending clients or investors to purchase US T-bills or US Treasury with their SGD, because currently we are expecting volatility in USD next year with excessive foreign currency exchange risk. So even though now we are looking at lower possibility of recession, and it has been decreasing, whereby we are hearing greater possibility of a soft landing, but we are still expecting US economy to weaken considerably. As a result, we still hold the belief that most likely USD will be relatively volatile next year, and we don't want investors to be exposed to overly excessive FX risk at this current point of time. So it is more recommended if you have excess US holdings and you're not sure where to park. So this can be a good place for you to look at. So coming to the last of our few sovereign bonds recommendations, the UK gilts. So for UK itself, UK is currently looking at one of the highest inflation rates still, with their headline inflation elevated still at 6.7%. This is in August 2023. And this is even though we are looking at high base effects across year on year. And given that inflation hit like 11.1% in October last year. So we believe that this is not a surprise ultimately, given that the market at this point of time, right, they are still expecting for further rate hikes, given that inflation is still relatively stubborn and relatively sticky. Although on the other hand, as you can see from the graph itself, what the market expects from the Bank of England benchmark rate, the market is expecting for a rate cut in the middle of 2024 as well, similar to US case, but we think this is a little bit too optimistic at this point of time, whereby inflation doesn't look like it will come down so soon. And this is particularly so on the backdrop of higher oil prices recently, and we believe the recent incident in the Middle East will probably spike up oil prices even higher. On the right hand side, you can see the yield curve, which, as you can see, is quite similar to what we see in the SGD, the Singapore government securities, and also in the US Treasury. So this is the reason why we are so focused and we prefer the short duration at this point of time, because this is a lot more attractive than what we have over the longer term. So our mandate continues that we prefer to look at short duration given the more attractive yields. And for us, our UK gilts offering, we have a couple on our Bond Express platform, but we do have quite a couple more available throughout in our entire platform itself. And this will be good for investors who have access, who have sterling pounds that you can actually utilize. So coming to the last recommendation of today, which is one retail recommendation and one corporate bond recommendation from Fraser's Property Limited. So for this itself, why we like Fraser's Property is ultimately because it has continued to do very well amidst the economic uncertainty. So across this entire year and also across last year, we have been seeing a lot of property developers doing a little bit poorer, not doing so well because of higher interest rates. But Fraser's, it continues to be relatively strong. On the other hand, we believe this is most likely of their very well diversified portfolio. They have retail, hospitality, and also residential, as compared to other property developers and managers that they tend to focus on a specific type of asset or property. So additionally, what we like about Fraser's is that the credit profile is extremely resilient, or it is quite resilient in our view. Of course, on one hand, they have a very well distributed debt profile. It is not concentrated in a particular year, or we are not expecting it to have a huge repayment in any of the year. On the other hand, even though we do see quite a lot of economic uncertainty, their credit ratios have been relatively stable over the past few years. And lastly, currently they are sitting on a relatively prudent cash and liquidity position, which we really like, and therefore we think that the bonds are really a good consideration at this point of time. So for Fraser's Property, for retail offering, for investors who prefer to consider a retail offering, the FPL 4.49% that is maturing in 2027 can be a good consideration. That it provides a slight yield pickup over the existing T-bills. So for those who prefer to lock in yields at a slightly higher amount, slightly higher than what the T-bills can offer, this can be a good place to consider. On the other hand, for investors who has a slightly larger quantum to look at of 250k, they can look in the corporate bonds, which is the FPL 4.15% that's maturing in 2027. This is offering an even more greater yield pickup over the T-bills, which Same thing is on a short duration side, which will be great for investors who is looking to lock up their yields and not having to worry about, hey, what if the yields continue to go down on T-bills, then where do I park? Then this can be a good consideration. With that, I've actually come to the end of my portion with all these 4 recommendations, 3 sovereigns and 1 retail / corporate. For any questions you might have, please feel free to type in the chat, which we'll be answering at the end of the entire presentation. If not, I'll be passing my time to Marcus, who will be elaborating more on the platform and what are the advantages that FSM can provide when it comes to trading bonds on our platform.
All right, thank you, Timmy. Okay, let me share my screen. Okay. All right, so whoever can see my screen. All right, so it comes to my presentation for this evening. So my presentation will be Bond Royal for Investments. So as what Ikai has mentioned, I am the manager for the Global Fixed Income team. So I'm actually doing more on the execution side and then oversee the business for bonds. Okay. Okay, so for the benefit of those who just joined us, so earlier on what Timmy has mentioned, he actually laid out what is the bonds. Basically, bonds are a loan taken out by the company. So instead of going to the bank, company goes to the investors who will buy his bonds. So instead of going to the bank to raise debts, they actually go to the investors and say, hey, we need actually raise a certain amount of monies. So we need to go to the market to actually raise debts. So in exchange for their capital, what we actually get in return is actually the interest coupon. So of course, if you borrow money from someone, you have to pay interest. So this interest comes in as a coupon, and that coupon would be your steady stream of income. It could be an annual basis, it could also be a semi-annual basis. So in that case, the interest paid is actually expressed as the percentage of the face value. So if you look at the bond, you can look at, for example, of that percentage that is into the name. Like for example, maybe HDB 3.498%, and then 2028. So that particular one is actually the interest of you are getting as a coupon. So just a point to note, bondholders lend funds to the issuer, all right? And then they receive the amount back when the bond matures. So alongside of the earnings over the bond's life. So for example, when you have when you purchase a bond, at the back of the bond's name, you will see a date. Okay, so particular date could be 2025, September 2026. So that one is actually your maturity, and which is also the bond's life. Another one that what Timing has mentioned earlier is perpetual. So perpetuals are the ones that doesn't have a maturity, or rather they have a callable date. So in that case, what the bond does is they will just keep rolling out, and then until the particular issuer will call for that particular bond, or the client actually sell the bond, and then of course then you will be taken out of the holdings. So the bond value of the bond, the market value of the bond, changes over time. So it becomes less or more attractive to potential investors, right? So for example, whenever the issuer comes out, of course, some of the bonds will be issued as par. So as the time goes by, depends on the market, the yield particularly will change. Of course, the price and the yield will be an inverse relation. So as the bond price moves down, of course, the particular yield will go up. This is how it will be more attractive to investors, right? So next point that I want to touch on is bonds that are on a higher quality. So what do you mean by a higher quality? So for example, if you want to lend a person money, that person maybe could be a very high creditable person, maybe Jack Ma. So in that incident, in this particular example, he will probably offer you a lower interest rate because in terms of credibility, he has that ability to pay you back. Then maybe in that case, what you get back on the interest will be lower, all right? So of course, for someone like with a lower credibility, could be maybe your friend or whoever it is, or maybe it's me, yeah, then maybe you can command to be higher interest rates. So because the credibility of my credibility is not as good as Jack Ma, for example. So of course, credibility in a sense affects what is your interest you get for your coupon. So fourth point, it's bonds that have a shorter maturity will tend to offer lower interest rates. So for example, if I issue a 3-year bond, the interest rate that we give it to you, or the coupon, will be more or less be lesser for the issuer that actually give you for longer maturities, like 3 years versus a 10-year. Of course, 10-year to lock in your monies longer, they will have to give you some incentivize on how you stay in that bond, or how you actually buy that bond, basically. So of course, what Tim has mentioned earlier, bonds that are issued could be by companies, which is a corporate bond, and also the government bonds. So there's also another part is quasi-sovereign bonds. So the quasi-sovereign bonds, of course, these are your HDB, your LTA, and all this. So these are also part of the corporate bonds under the segment. Right. So moving on to the benefits of buying bonds from IFAS. Of course, we have a top 5 reasons. Of course, the whole market, there's a lot of competitors. So it's just to show you in terms of what's the difference if you actually trade bonds with us. First of all, we emphasize a lot on transparency. Okay, so I think this is something that we are very proud of and taking the pride of. Because when we actually purchase a bond, we can manage to source a lower price. We will never embed any markups into the bond price. So whichever prices we get from our counterparty, of course, when we actually execute the bond, we will look for the best possible prices. So on our side, I think we have about 50 to 70 counterparties already. So whenever we have an order to buy a bond, we will definitely visit all those counterparties, and then we see what is the best price. So best price meaning that if you are buying a bond, we will try to find the lowest price. Of course, if you're selling the bond, we will try to find the highest price possible to help the client execute. And we will never embed any fee into the bond prices. So whatever that we get, we will pass on to the client. Of course, what I mentioned earlier is best execution. So best execution is something that what our bond execution team is committed to provide. So as I mentioned earlier, whenever we have an order, we have the obligation to go to the market and then try to source on the best pricing for the client. So even though you have a limit order, for example, maybe you want to buy a HDB bond and you put the price at maybe 102, and then we are able to find the bond at a lower price. Maybe we find it 101. So we will not give it to you and say, hey, no, Mr. Lim, we have already buy the bond, although we actually bought it at 101, we price it to you at 102. This is your limit. We will never do that. So what we do that is we will actually give you at 101 exactly the price that we transacted from our counterparty. So the third reason, it's competitive fees. Of course, so for example, there are some banks, of course, I've not mentioned the name, they charge up to 2% for privileged clients. So for example, I think one of the client actually came to us and then he mentioned that one of the bank actually charged him 2% to buy a US Treasury. Of course, that particular Treasury is a longer dated. I believe it's a 2050 long dated bond. But then again, I think he was quite upset because after learning that our fee was quite low, so he feels that the bank is actually overcharging in that sense. But for here, we are very competitive in that sense that whenever you buy the bond, you will definitely feel that the IFAS fee in comparison to our competitors, it will be one of the most affordable and then most value for money. All right, so the fourth reason is the comprehensive bond information. So just now, Feng Yi earlier on has showed you our platform, Bonds from our platform. Okay, so this platform is very, I would say, comprehensive in the sense that it allows the advisors, it allows the clients, okay, who actually go inside and then to see the information, okay, without actually paying any money. So all this information are very crucial for the client to buy the bond. So information like the ratings, and then the prices, and then all the bond features are very carefully listed in that particular website. So I mean, you can actually go outside and see which are the website that actually shows so comprehensive information, and without you subscribing into the website, and then without you actually registering as a client and pay a certain fee. So for Bonds World Mart website, it's totally free. Anyone, even the clients who are not really our client yet, can go inside and then to source for the bond, and then look at the prices, and then of course look at the features for every bond that we have. And then of course the last reason is of course our Bond Express. So the Bond Express is very uniquely for IFAs. So what does Bond Express do? Bond Express is actually allow the investors to trade bonds in odd lot sizes. So currently bonds is trading, for those non-retail ones, bonds is trading under 250,000 for SGD. And then if it's a USD, it'll be 200,000. So sometimes client will feel that, oh no, this amount is quite huge in that sense, because although I have 200,000 or 250,000, I want to actually maybe spread out my risk, and then I don't want to only buy one bond. So for Bond Express, what you can do is you can actually buy as low as 5,000, and then you can actually buy a few bonds so that you can spread out your risk and not just putting many eggs into one basket. Right, so what I mentioned earlier, so Bond Express aims to provide the clients with real-time bond experience, okay? So it's like trading stocks. So currently, stocks, because we have a regulated exchange. So in that exchange, they will allow you to take a look at what is the current market price. But for bonds, mostly are OTC market. So a lot of times, the clients don't have a visual on what is the current market price. And then a lot of times, if you have been trading bonds with us, once you put the order with us, you have to wait for a while, and then you don't know what is the price that's being executed, because our dealers are trying to negotiate with the counterparty. But with Bond Express, it's very different. For Bond Express, whatever price you see are firm, and then you can just execute it. You can just execute the order, and then you'll be done straight away. So it will be very similar to what you experience as a stock trading, where you see the prices, you execute, you get that particular price. Right. So these bonds are available for immediate trading, where IFAs deals at principal. So what does it mean? It means that for IFAs, we actually do keep an inventory of the bond in the Bond Express. Of course, the Bond Express don't have the full universe of the bond as what we market has. We co-invest in those lists of Bond Express bonds. I think for SGD, we have about 33. USD, we have about 34, 35 as well. And then also we have some pound papers and AUD papers. So these are the bonds that we also co-invest in our inventory. And then whenever the client buys through the Bond Express, we will sell them in odd lot sizes, right? So as I mentioned earlier, bonds are usually purchased in bigger sizes for wholesale, 250,000 or 200,000. And then we are able to sell in small lots. And then this allows the clients to diverse their risk, and then they can also try to buy a certain bonds that they feel comfortable for the name, right? So as I also mentioned earlier, for the odd lot, it can be as low as 5,000. So we do also have some US Treasuries in our Bond Express. So for US Treasuries, we also allow up to 1,000 minimum size, and then also accumulative. Right. So of course, the prices that how we actually derive from Bond Express. For IFAs, we do have our own market maker, and we market make our own prices for the odd lot sizes. Right. So just to continue on, so if you invest in smaller sizes, of course, what I mentioned earlier, it minimizes your exposure to a particular industry or issuer. So your risk will be reduced dramatically. And then, of course, we do away with indicative pricing. So for example, if you see the pricing at 98, you execute the order, you will get 98. So there is no questions asked. There is no, whether or not can we actually get a price. So of course, immediate trade is something that we want to emphasize because a lot of times OTC, if you trade on secondary market, you really can't get the immediate execution because what we call is a second look. So we do have a take pride in maybe don't allow, basically. So we take pride in actually revolutionize how we trade bond. Basically, so instead of doing a second look, we actually execute the order immediately. So of course, just to emphasize, for Bond Express, it's only available for AI clients. Okay, so non-AI clients can also buy Bond Express, but in the sense that it has to be 200,000 SGD or higher in its foreign equivalent currency. Right, so these are just very few examples of the names that we have in our Bond Express list. So these are Barclays, Fraser's Property that Timing has mentioned earlier. We also have UOB, and then the ESR Cayman, Thomson Medical, as well as Bayfront Infrastructure. And then the latest addition that we have is actually the LG Energy Solution, which is one of our the newest onboarded bonds, and then the issue is from Korea. Okay, so I'll read out the last few slides as what the Timmy has mentioned. Government bonds, Singapore government bonds is actually available in our platform. Okay, so the FSM1 platform, we try to be as comprehensive as possible. So we try to distribute as much as bond within the market. Of course, SGS government bonds is one of them. All right, so client can simply invest, subscribe online to the 6 months and 12 months Singapore T-bills, okay, as well as the longer tenor SGS. So these are the ones that is 2 years to 50 years. So not sure you have mentioned, not sure you have realized that if you look at the SGS, you realize that some is actually called SITB and some is called SIGB. So SIGB is the Singapore government bonds. So these are the ones that has a coupon. And then SITB is actually the treasury bills. It's something that is kind of quite popular right now because of the yields at the moment. So it's a 4%. So this SITB is available as well as the SIGB. So for Singapore T-bills, the clients are able to place subscription as early as the next day after the announcement. So for example, let's say if the announcement is on the 5th of October, which is last week, and then you can actually invest it, rather subscribe it, and then on the next day, which is on the 6th, and then for us, we will just accumulate the order as our indicator of interest. And what we do is on the auction day will be tomorrow, basically. So on auction day, our dealers will actually carry out the particular subscription order, and then we will pass it down to our counterparty, and then we will subscribe for our client. So the client will be, of course, be notified real time on the allocation status. So if you are allocated, there will be emails, and then there will be notification to notify you. So in that case, client would be informed immediately once the allocation is confirmed. So of course, after allocation, if you have made your payment, clients can also see the particular T-bill bonds inside their holdings. Right, okay, so this is like an example that what you will see. So earlier on, Feng Yi has showed you that we have a small little button, subscribe button for the new issue. So what happened if you click on that button? So I'll just give you an example on how you can actually subscribe if you go into that particular page. So you can see that, of course, this is your personal account, and then the issuer name, the bond name. Just make sure that you are subscribing for the correct bond, basically. All right. So of course, what is the price guidance? So price guidance is a range that you can actually subscribe for your T-bill. right? So for example, the particular range 3.3 to 4.3, you can subscribe for maybe 3.4%, no 3.5%, so on and so forth. So the highest range you can subscribe is actually 4.3%. So of course, we actually put it as a nominal value. The minimum nominal value for subscription is 10,000, and the incremental is 1,000. And then payment mode is of course cash only. I think so. We have some of the clients actually ask us whether we have CPF for SGS or T-bills. We are still working on it. So the current mode that we actually accepting at the moment is only cash. But of course, through this feedback, we are also trying to see whether how we can improve and offer that in the near future. Right, so nominal value, you can just actually key in your nominal value. You can key in multiples of 10,000 by 1,000. So it's 11,000, 12,000, so on and so forth. And then you can buy at the market order or limit. So market order meaning that what we call a non-competitive. So non-competitive means that you are okay to accept whichever that the cutoff yield is. So for example, the cutoff yield is at 3.8%. It means that you are able to accept it. This is what we call the market order. Then limit order, of course, if the client will feel that I have a maybe I want the yield to be 4%, for example, then you will key in the limit yield as 4%. So if the particular cutoff is below 4%, then of course you won't be allocated. Of course, there will be a processing fee. So processing fee and counterparty fees still applies. So after you key in the first page, okay, and then you scroll, you will see the payment instructions. So you just need to actually click on the declaration and then to verify all the disclaimer and verification. And then after that, you just submit and then you are being subscribed already. So it's that easy and that seamless. So after you subscribe already, as I mentioned earlier, of course, whatever they're being allocated, you will be notified on the same day itself. Okay, I have already go to the last part of my presentation. So I just pass on the mic to Yikai.
Thank you so much, Marcus, for sharing. It's a very wonderful sharing, and I guess a lot of our attendees here have a much more deeper understanding of how we can buy the bonds over at Bond Express and our FSM one itself. All right, so now we'll open up the floor to questions. Thank you guys for putting on the questions, and I will leave Feng Yi, Timing, and Marcus to tackle the questions.
Right, I believe I can go first. So I see quite a couple of questions I would like to answer live. So firstly, on the views of Singapore savings bond, sorry. So I think this is quite an interesting question. Of course, we're on the topic of Singapore's treasury bills and also Singapore government securities. Singapore savings bond is definitely part of the Holy Trinity, like the three different types of saving bonds or the bonds available through the government. So for Singapore savings bonds, I think you all can see from the recent issuance that the average yield did go up. Largely is because ultimately the yields on the Singapore savings bonds, right, is determined by the 1 year, 2 year, 5 years, and also 10-year yield on the Singapore government securities. Recently, we do see a quite big jump, a spike in the 10-year, in the yields on the 10-year Singapore government securities, which is allowing for this spike on the latest SSB also. So in this case, right, I am still expecting SSB to go up slightly, but however, don't get your hopes too high up, because for SSB, right, the current yields are still relatively much lower as compared to the 1 year, 2 year, 6 months, 1 year, and 2 years Singapore government securities that we have. So ultimately, we still prefer for short duration because ultimately you can get higher yield on short duration. So what is the consideration over a longer period? Secondly, although Singapore savings bonds allow you to lock in the use over a longer period, you have to understand for Singapore savings bonds, they tend to be a lower liquidity because ultimately you can only redeem on a monthly basis. Whereas for T-bills and also Singapore government securities, you are able to trade them on the secondary market. So you're able to sell them at any point of time should there be other buyers that are willing to buy them. So although SSB might be going up in the near term, but I think we do think that the short duration will be more attractive at this current point of time. So
yeah, I will take over the second question now. So the second question is how liquid is T-bill on our secondary market? Right. So so the T-bill, I would assume that is the SGT bill basically. So of course, SGT bill, I would say it will be recommended to trade the T-bills on the primary issuance. Why is it so? Because on the secondary market for T-bills, SGT T-bills, it will be not as liquid as the SGS. So some of the counterparties may be out of sizes for some of the T-bills. So I think I get an example, like for example, the last previous issuance, some of the clients came back to us and say that, hey, I am very interested in the cutoff yield for the particular SGT bill. Can we actually source it in the counterparty? So and then we try to find it into the market, but unfortunately, all of our counterparties are our sizes. So in my opinion, is for the SGT bill, it's best to actually trade it on the primary issuance. Of course, if you're talking about the US T-bill, it's extremely liquid, definitely.
So maybe I'll take on the next one. And Marcus, I think you can add on because it's a question on Bond Express. So somebody asked if you need to be an AI to trade on Bond Express. So AI investors can trade in the smaller denomination investment amount, for example, SGD 5,000. But in actual fact, actually anyone can trade. But if you are not AI, then you will have to conform to the standard minimum investment denomination for each bond. Yeah.
Yeah, so I just elaborate a bit. So for Bond Express, like what Feng Ye has mentioned, is for AI. Why? Is because Bond Express is actually designed for odd lot trading. So if you're not an AI, then you have to buy at least 200,000 SGD, right? So but then if you are buying through the Bond Express, so long as you buy conforming to the SGD 200,000 and above, yes, you may be able to actually buy. But if you are not buying 200,000, then you must be an AI to trade Bond Express.
Okay, I think I can take one more question, which I do see a pair of interesting questions. One is, given MAS is using currency as a monetary policy tool, does USD SGD play a part in T-bill pricing? And also, we are often told that Singapore interest rate move in tandem with the US. Why then is the Singapore's government bond yields much lower than the US? So thankfully, the other question answered the other question. So largely it's because the forward pricing on USD SGD plays a part in determining the Singapore government securities and the T-bills pricing. So what happens is that they do take into account the potential or the what is expected on the forward pricing for USD SGD pair, which came into reality at the start of the year, whereby we do see a lot higher we do see a quick, large sharp drop in USD against SGD, whereby USD came from more than 1.4 something, dropping to 1.31 at the start of the year for USD SGD pair, which since the start of the year, we do see quite a, the drop in the T-bills use also, which ultimately is coming actually like, they are taking into account of the FX, what's the forward-looking pricing on the thing into the pricing of it. So more importantly, at the same time, right, for a lot of the T-bills and also Singapore government securities, the pricing power mainly is based on the institutional players. So the institutional players hold the bigger pricing power when it comes to determining the yield on the Singapore government securities and also the Singapore T-bills. So largely based on what they expect the yields to be and what the forward pricing to be, they are actually able to not exactly manipulate, they are able to price it to their favor or what they expect. So usually it's based on what the larger institutional players are expecting at the same time. Yeah. So that is all for the two questions.
Okay. Sorry. Yeah. So I see some questions regarding the Bond Express, so I'll answer that as well. Okay. So one of the questions asked is the bid-ask spread wider for Bond Express? Right. So as I mentioned earlier, the Bond Express, the prices are being market made by our own market makers. Is the spread wider? I would say a lot of times we are actually showing a very competitive prices in compared to the market. So I give an example. One of the clients actually going to see the Fraser's 4.98 perp. Okay, and then he realized that whenever he checked from our dealers, the wholesale sizes is actually about 10 basis point actually, 10 basis point more expensive than our more express prices. So why is it so? Because when our market maker add it on inventory, he or she could actually purchase the bond earlier. And then when we actually purchase the bond earlier, the purchase price could be cheaper. And then this is how we can actually provide a better pricing for the client in compare to the wholesale pricing. So we have a lot of bonds. And then, of course, in our inventory, as the bond prices moves, we will definitely remain as competitive. And then we will definitely try to give a more competitive pricing in compared to the wholesale market.
I am going to sort of arrow teaming. Do you want to take the question on what is FS1 view on the Astra 4.125% retail bond that's going to mature in 2032?
Right, sure. Yeah, so that's another interesting question also. Okay, so we don't exactly have a very strict view on Astra, but I think Astra is one of the more popular retail bonds available in the Singapore market as well. So for Astra itself, right, we don't once again we don't have a particular view for each Astra series. So this Astra 4.125 is actually the Astra 7 series. Quite recently, we do see the Astra 6 series coming out with another ratings upgrade. It should be AA minus at this current point of time, if I'm not wrong, mostly because the credit rating agency, if I recall correctly, is Fitch, determined that they have a sufficient reserve amount for them to redeem fully without having to, so you're expecting them to actually redeem the Astra 6 in 2026 fully without any issues based on what they have now. So most likely what we want to reiterate for Astra, right, given that it's a setback security, it is quite different from the standard bonds that we do understand. That means you can think of it as a secured bond. So ultimately, it's quite dependent on the cash flow of the underlying private equity funds that it invests into. So we would like to advocate for investors to keep track of how is the cash flow moving, how has the cash flow been, how is the cash flow expected in the future, for them to know that actually for this, will it be safe to invest in this, and what is the timeline for them to be able to redeem. So at least they can keep track. For investors, you'll be able to see clearly, oh, are we expecting for the Astra 7 to be called back in 2027, or will it be further extending into maturity until 2032? So for Astra 7, do take note, it has a call option in 2027, which ultimately, if it's not called, there will most likely be a step up of interest rates. But it is in Astra's favor to actually call back, and in the event they are unable to call back, then there will be a step up. But in their mandate, they will want to call back as early as possible, which is ultimately they will want to call back in 2027. So it will be in your favor to actually keep track and to see whether by 2027, are they able to fully redeem it. Yep.
Okay, so I have one question that actually asks about our fee, basically, so I'll answer that. Okay, so it says that the IFAS charge, is it dependent on individual bond or is it fixed? And then is it every transaction have a reference charge to compare to other institutions? I would say it's depending on the different class. So for example, if you're investing in corporate bonds, you'll be a 0.35%. And then if you're investing in these Singapore government bonds, you'll be at 0.1%. Yeah. So if you're investing in government bonds, of course, the fee will be lower. How are we compared to other institutions? Well, I don't think that we are I would definitely say that we are in line in the market, definitely. And then I do see that there is other competitors that charge a 50 basis point. I would say that our fees are rather competitive in comparison to other institutions. Yeah. And then, of course, I want to elaborate that the transparency is something that we take pride. So we always try to show the client what are the fees that you're being charged, and we will never say that no, we charge you free of charge. There is no processing fee, but then we add whatever charge into the bond pricing, so you don't know exactly what you're being charged. So this is something that we will never do. Yeah, I think we have one more question. when purchasing the SGD wholesale bond, can the bonds be credited directly to our CDP account instead of being held on your platform? So I'll just answer that. So so when you buy the wholesale bond, of course you'll be under IFAS custody. Of course, if you choose that under IFAS custody, you want it to be on other custodian, of course you can move directly. But in a sense that whenever you buy the bond, you'll be custodized under IFAS first.
All right, I guess we have last two questions. I will leave the last two questions to Timmy, and then thank you very much on that.
Okay, let me quickly answer the CPF question. So when using CPF to buy T-bills, is it more worth to buy 1 year instead of 6 months? The cut-off competitive bids seems to be quite similar. Ultimately, it actually depends on individual, what you are expecting the auction cut-off yield to be, which is based on the market. So this one, I cannot really advise, but what we would like to remind is that for buying through CPF, right, ultimately you might miss out on the CPF interest rates depending on when you are buying in. This is because of the mechanism behind whereby if you're utilizing your CPF, the transfer might happen a bit earlier, which you might not be able to get your CPF interest for that particular month, given that it's based on a monthly basis. So in the event, you actually will require a little bit more yield on your T-bills to make it more worth because of the additional interest that you might miss on your CPF. So that is something that you might want to take note of. So last question is by Wei In. Could you provide your views on the topic of this webinar, please? T-bills use, can we predict where they are headed next? So I think this will be a good closure for this webinar again. So let me reiterate what I mentioned previously. So what we believe that currently the T-bill use are most likely going to stay range bound between this 3.7 to 3.9 range. What happened for the 4.0% is likely going to be an exception case, given that we do see a lot lower demand than the usual amount that we see over the previous option. In this case, especially given what we're expecting moving forward, especially the divergence from the US interest rates, we do expect that the Singapore T-bills is likely going to stay within this limited range, 3.7 to 3.9, and potentially in 2024 likely going potentially it might go down even further. So currently that is the reason why we feel that it's currently quite attractive, because if you don't buy into it now, you might be missing the chance to buy into a T-bills that is offering at this yield in the future. With that, I believe we have come to the end of the Q&A session. I will pass back the time to Ikai.
Let me just briefly add on. So it's on T-bills, and I think someone also asked about Singapore Savings Bonds, SSB, right? So as an ending closure also as part of the Singapore Securities, just wanted to share that for SSB, we don't carry. You can actually subscribe through the local bank and apply through them directly. Yeah. So now really on to you, Ikai.
All right, thank you so much. Thank you, Fong Yi. Thank you, Timing. Thank you, Marcus, for the wonderful sharing. And I'm very, very appreciative that you guys are here to also answer all the burning questions that that all our attendees have. And also a big thank you to all the attendees here, who is here with us this evening. I hope you guys find this sharing useful in your investment journey. So I just want to share a bit of something, so a bit of plug for myself. So give me a moment. Yeah. Okay, so I'm going to share my slides. So I just want to share that if you are new to FSM, I mean, you join us through our social media ads. We do encourage you to open an FSM account today. Opening an account is free, and if you're using MyInfo to open an account, it's the most immediate. So to help you along, I have showed the QR code to our sign up page. And you can just scan the QR code, log into our webpage, and then sign up for FSM account using our using your MyInfo, using your MyInfo. And of course, we do have a special gift for all the people who stay here, stay with us till the end. So we are running a promotion whereby we are awarding customers who buy sovereign bonds that was mentioned in the webinar earlier, T-bills, SGS, and the UK GLITs and the US Treasury bills. So as long as you buy through FSM, we will be giving out free trades. So there's quite a few terms and conditions and quite a few explanations to go along with it. So I will leave the QR code here also on for a few seconds for you guys to go and check out the article that we have run up for you guys.